New York State, if you want new businesses, new jobs, and stronger communities, you need to be more bold. Be bold, New York State. You already have set a 6% goal for service-disabled veteran-owned businesses in state contracting. You already built certification, outreach, and purchasing tool. That deserves true recognition. But leadership is not a trophy you win one time. Leadership is the decision to ask what comes next. So here's the VestVet challenge to New York State. Build a serious 5-year tax incentive for qualified veteran-owned startups and design it well enough to prove whether it works. In episode 12, we asked whether America needs a national baseline for state SDVOB opportunity. New York State gives us a real case study because the state is not starting from nothing. The Service Disabled Veteran-Owned Business Act created a program and a 6% participation goal. The Office of General Services reports that more than 1,400 active certified firms and more than $1.76 billion in payments through the program. New York State also allows purchasing tools that can help agencies reach qualified firms. Those facts do matter. We should not erase the existing work just to make a louder argument. We should use that work as a platform for the next one. Procurement helps companies reach an important customer, but many businesses never become ready to pursue a state contract. They struggle earlier, during formation, during the first hire, during the first equipment purchase, during the period when revenue is uneven, but insurance, payroll, rent, software vehicles, and professional fees still arrive. New York has a hire a veteran credit for qualifying employers. That supports veteran employment under defined conditions. It is not the same as a broad incentive for a veteran who owns and is building the company. That is the gap this proposal asks New York State to examine. For the first 5 years of a qualified SDVOB business, provide 50% back on state taxes to help the company start and reinvest. For established SDVOBs beyond 5 years, considered a relative incentive tied to qualified reinvestment, growth, jobs, or expansion. That is a bold direction, New York, but 50% back is not yet a policy. 50% of what? Corporate finance tax, personal income tax attributed to business income, payroll-related taxes, qualified startup expenditures, sales tax on certain equipment. A credit can be refundable or non-refundable. That difference matters because many young companies have little taxable profit. A non-refundable income tax credit may sound generous while providing limited, immediate help to a business that's still operating near break-even. A refundable credit can deliver more cash, but it also creates general fiscal costs and demands stronger verification. Design determines whether the promise reaches the actual founder. The policy should state what public outcome it is trying to create. More qualified business formation, more survival, more New York jobs, more investment in equipment, more activity in underserved communities, more firms becoming procurement ready. A credit cannot maximize every outcome at once. If the goal is startup formation, support might focus on verified startup and organizational costs. If the goal is employment, the credit might reward qualified payroll growth. If the goal is productive capacity, it might support equipment, technology, training, or facility investment. If the goal is keeping companies in New York State, eligibility require meaningful in-state operations over time. The public should be able to understand what behavior taxpayers are supporting and how success will be measured. Businesses older than 5 years should not hear, well, you survived without help, so you no longer matter to us. Established SDVOBs may be preparing to hire, expand, buy equipment, enter a new market, or acquire another company. They may also be the firms capable of mentoring younger founders and delivering larger contracts. So consider a separate reinvestment credit or competitive program tied to measurable expansion. Not an automatic payment for just simply, oh, I'm existing here as a business. A targeted incentive for doing something that creates public value, new jobs, apprenticeships, new productive assets, expansion into a distressed region, acquisition and preservation of a viable New York business, cybersecurity, or qualified upgrades required to enter an important supply chain. Again, the details decide whether the idea actually becomes serious. A strong veteran business incentive must protect taxpayers and legitimate founders. It must require real ownership and control, and it must prevent temporary transfers created only to capture that tax credit. Define related entities and common control. Prevent double benefits on the same expense unless lawmakers intentionally allow them. Set reasonable caps. Require records. Create audit authority and penalties for fraud. Use a sunset date. Publish an evaluation before renewal and protect private taxpayer information while reporting useful results here. The policy should be accessible enough for a small legitimate company to use and strong enough to deter a sophisticated shell arrangement. That balance is difficult. New York State can do difficult things. An incentive can exist in law and still fail in practice. If the application requires a small founder to hire an expensive specialist before knowing whether the business qualifies, the design may reward sophistication more than need. Create plain language guidance. Publish examples of eligible and ineligible costs. Give applicants one accountable point of contact. Coordinate tax, certification, and economic development offices so a veteran does not receive three incompatible answers. And establish a process for correcting an honest filing error without treating every mistake as fraud. Strong enforcement and usable administration belong together. The goal is to not merely to announce a bold percentage. The goal is to make productive investment possible for legitimate New York veteran-owned businesses. Start with a defined pilot if necessary. Choose a duration. Estimate the fiscal cost. Set application and certification rules. Track performance, track formation, survival, employment, payroll, capital investment, track the geography, the procurement participation, and track the cost per verified outcome. Compare participants with a meaningful baseline where possible. Ask whether the incentive changed behavior or simply rewarded activity that would have happened anyway. Then publish what you learned. A program that cannot survive measurement is not bold. It's just simple, stupid branding. New York State has already said service-disabled veteran-owned businesses deserve meaningful access to state opportunities. Now, the state can ask whether contracting alone is enough. Define the tax, define the eligible company, define the public outcome, protect against waste, fraud, and abuse. Include responsible growth for established firms. Protect the idea, measure it, improvement. New York government, this is the challenge. Do not tell veterans only that you honor their service. Build a policy serious enough to help qualified veterans create, employ, invest, and remain in New York State. In episode 14, we will take the 5 years question to Washington and examine what a federal veteran startup incentive could actually look like. New York State, be bold, then prove the bold idea works. So I want you to subscribe to the VestVet Debrief. Hit that subscribe button down below on this channel so you can listen to the bold ideas we come up with next.